Hello everyone, how is your day going? In today's presentation, we are going to discuss fixed versus variable mortgage rates decision, the best mortgage rate. The mortgage in your house is most likely to be the highest debt you will ever incur in your lifetime. So it is worthwhile to ensure that you choose the best mortgage rate for you based on your individual preference and your unique financial situation and risk. Before we proceed, a quick reminder that you please subscribe to my YouTube channel if you have not already done so. Also like and share my videos with your family members and friends so that they can also benefit from the financial education that we are sharing together. Now let's get started. When you are approved for that mortgage, when you are ready to buy a house, you are faced with two major choices. What kind of mortgage interest rates will you choose? What interest rate can you lock in for, say, 5 years, or you want to leave it floating? These are the main choices that you are faced with: fixed or variable mortgage rate. For a fixed mortgage rate, typically the interest rate and the term is fixed for a period of time, typically 5 years. Your payment is known in advance, and it is the same for the period of the term. You know exactly how much you are going to pay in interest and in principal for the term of the mortgage. Let's take an example to explain a fixed mortgage rate. This customer is approved for $300,000 mortgage. Amortization time is 25 years. And let's assume that the interest rate is 4.99% and it's a 5-year fixed mortgage. When you do the calculation on this customer based on the criteria I've mentioned, the monthly payment will be $1,743.11. So for this customer, this amount will be the same for the 5-year term of the mortgage, irrespective of whether or not interest rates are going down or up during the period of the term. Okay, now let's talk about variable mortgage rate. A variable mortgage rate is simply a mortgage with payment set for the term, but the interest rates may fluctuate up or down during the term of the mortgage. If interest rate goes down, more of your payment will be applied to reducing the principal on the loan. If interest rate goes up, more of the payment is applied to the payment of interest. Like a fixed mortgage rate, variable mortgage rate can be open or closed. Variable mortgage rate provides you with the flexibility to take advantage of falling interest rates and the flexibility to convert to a fixed rate at any time. Let's look at an example. So, same customer with a mortgage of 300,000, and amortization period of 25 years. This customer pays his mortgage on a monthly basis, but the interest rate is 3%. Notice that in our first example, for the same customer, the interest rate was 4.99%. So the variable mortgage rate is lower usually. So for this customer, the monthly payment will be lower at $1,419.74. So this will be the monthly payment. With examples 1 and 2, the monthly payment for the same customer, the same mortgage amount, the same term, and the same amortization period is $1,743.11 compared to $1,419.74. That is a difference of $324 on a monthly basis. This is huge. Now let's leave it at that, but just bear in mind that the difference is $324 on a monthly basis. Now let's do more comparison. Let's compare the fixed and variable mortgage rate. Let's start with a fixed rate. So with a fixed rate, you are locked in for the term, usually 5 years. No surprises, you pay the same amount throughout the term. It doesn't matter what's going on with inflation or any other thing in the economy. The rates are typically higher. In this example that we just saw, 4.99% versus 3%. But you are sure of consistent payment throughout the period. If you break the mortgage, there's often a higher penalty compared to a variable mortgage. It is not possible to switch from a fixed rate mortgage to a variable rate mortgage without paying penalty. Now, let's talk about variable mortgage. The rate of a variable mortgage usually changes over time based on the decision of the central bank in any country. The rate is usually determined using a discount of the prime rate. For example, if the prime rate in your country is, say, 3%, a bank can give you a discount of, say, 0.5, and your rate could be 2.5%. Typically, the variable rate is usually lower than the fixed rate. But, like I said, it fluctuates over a period of time. If you decide to break your variable mortgage rate contract, the penalty is usually lower compared to a fixed mortgage rate. What are some of the factors that you have to consider before you make a decision on which is best for you, variable or fixed? We've known the difference, but you still have to consider your own personal situation. Number one factor to consider. Think about if mortgage rates will go up or they will go down during the term of your mortgage. So if you are taking a 5-year mortgage, just think about it as a whole, based on whatever information that you have. Will interest rates rise? Will they go up during the term of my mortgage, so in the next 5 years? If the answer is yes, it is better to take a fixed mortgage. Just lock the contract down and you will pay the same rate for that period. Now, What if you think that interest rates will be going down? Maybe because of COVID, maybe because the bank is trying to fight the central bank is trying to deal with any situation, any form of uncertainty. If for whatever reason you think that interest rate will go down, then it will be better to go for a variable mortgage rate. Now the difficulty happens where over that 5 years, interest rate may go up and also go down. So it's difficult to really predict what will happen. So it's just a question of judgment. I think interest rate will go up, fixed rate mortgage. I think interest rates will decline, variable mortgage rate. Next, your risk tolerance. Some of us appreciate and want peace of mind. Some of us want to take risk, or I would say calculated risk, based on information that we have. So if you are the type that want to risk the rates for the term, believing that rates may go up, but they may also go down, and you want to take the risk, then variable mortgage rate is for you. And the good thing is that historically, as a whole, variable mortgage rates have proven to be lower, even when rates go up and or down. So if you are choosing a variable mortgage rate for say 5 years, and by chance interest rates go up, I would say when you want to renew, just continue with the same variable rates throughout the amortization period. So throughout the 25 years of your mortgage. Do not panic and choose variable mortgage rates for the first 5 years and fixed rate for the remainder of your amortization time. Then that historical findings will not favor you. The spread. So you look at what's the difference between my payment or my rate if I choose a fixed variable rate, or if I choose a fixed rate or a variable rate. In our example, we saw that the difference was over $300 a month. For me, that's a risk I will bear because it is worth it. $300 a month times 12 times 5 is a huge amount of money. Now, what if the difference is small? Say the difference was, say, $50 a month. Then I will go for a fixed mortgage rate because it is not worth the uncertainty. In this case, I will choose my peace of mind. So always consider the spread. What's the difference if I choose fixed or I choose variable? If the difference is large, go for variable. If the difference in the rate is small or marginal, then lock that rate in with a fixed mortgage. Then consider the penalty. And this has to do with uncertainty. Ask yourself a question. If I sign a fixed mortgage with any financial institution, I'm tied in for the next 5 years, assuming a 5-year term. Do you plan to move? Do you plan to increase the size of your family? Will there be other uncertainty that you need to consider? Because if for any reason you break that mortgage, the penalty will be huge. So if there's so much uncertainty, you want to move, you want to relocate, you want to change job to another location, and you are not just sure of what will happen in the next 5 years as an individual or as a family, then it will be better to go for a variable mortgage rate so that you can leave the contract at any time without a large penalty. But if you are certain that you can maintain the contract to maturity, then go for a fixed mortgage rate. Here is my final thought to conclude. The choice of a mortgage type depends on your own personal situation and your comfort level with risk. I have provided you with information to help you in your analysis. However, the final decision is yours and is personal to you. Think of your personal situation and circumstance and think of your risk tolerance. We have to stop here for now. A quick reminder to please subscribe to my YouTube channel if you have not already done so. Also, like and share my videos with your friends and your family members. If there are topics you would like me to discuss in my future presentation, please put those suggested topics in the comment section. Until my next presentation, thank you very much. Merci beaucoup and bye for now.